By every official measure, the economy appears to be stable. Unemployment is holding near 4%, job growth looks resilient, and GDP continues to climb. Yet, there is a persistent sense that the financial foundation is far less secure than the headlines suggest. The pressure is visible in the household data. While real income has largely flatlined, cumulative inflation has climbed more than 25% since 2020. To bridge that gap, Americans have pushed credit card debt to a record $1.28 trillion, not for luxury, but to cover the increasing cost of basic survival. This friction between the reported growth and the lived experience exists because official data is inherently trailing. These metrics are not a real-time reflection of the economy. They are a rear-view mirror, often taking months or even years to align with the reality on the ground. The National Bureau of Economic Research, or NBER, is the body that officially declares a recession. Their methodology is intentionally slow, requiring 6 to 18 months of comprehensive data confirmation before they make an announcement. This means a downturn is only identified long after the public has already navigated its effects. History proves this lag is the rule, not the exception. In 2008, the NBER didn't announce the recession until December, a full year after it had actually begun. By the time they made it official, Lehman Brothers had collapsed and the global financial system was already in a state of emergency. We saw the same pattern during the dot-com bubble. The recession started in March 2001, but the official declaration arrived in November, 8 months later. Because the system requires comprehensive data, the official record will always be the last thing to change. It ensures that the people living through the crisis are the ones who know it's happening first, while the institutions are still waiting for the spreadsheets to catch up. Take the 4.4% unemployment rate. It is often cited as proof of a tight labor market, but that number excludes anyone who hasn't actively applied for a job within the last 4 weeks. Since the pandemic, more than 1.6 million Americans have stopped looking for work, disappearing from the statistics entirely. There is also a quality gap. If a full-time worker takes 2 part-time jobs to stay afloat, the government logs that as net job growth. To the data, one person struggling with 2 roles looks better than one with a stable career. This explains why 4.4 million Americans are currently working part-time because they cannot find full-time work. They are technically employed, but they lack the benefits, security, and consistent income that a healthy labor market is supposed to provide. By prioritizing the quantity of jobs over the quality of employment, the headline numbers can project strength, while the actual workforce is being systematically hollowed out. A similar distortion exists in consumer spending. Media outlets often point to high retail sales as evidence that the consumer is resilient and that the GDP is healthy. But the spending isn't coming from higher earnings. People are borrowing more to cover the basics. It is a temporary fix that creates a long-term problem, effectively using high-interest debt to maintain a standard of living that wages no longer support. The personal savings rate has dropped from its historical 8% average down to just 4.5%. Meanwhile, the interest on that credit card debt has climbed to 22%. People are depleting their safety nets just to keep the lights on. The GDP counts this debt-driven spending the same way it counts income-driven spending. It creates a facade of growth right until the moment the consumer can no longer afford to borrow. This gap between measurement and reality is a textbook example of Goodhart's law, the idea that once a metric becomes a target, it ceases to be a good metric. Because institutions and markets are now optimized to hit specific headline numbers, they have stopped optimizing for the health of the actual economy. They manage the unemployment rate by ignoring job quality, and they manage the GDP by ignoring the debt required to fuel it. We are no longer measuring the economy, we are managing the metrics. That is why your daily experience can feel like a crisis, while the official report says everything is fine. To see where we are actually headed, we have to look at the indicators that cannot be easily gamified. The leading economic index, designed specifically to forecast downturns, has now declined for 6 consecutive months. The corporate sector is also beginning to fracture. Commercial bankruptcies have risen over 7% to more than 24,000 filings. That is the highest level in over a decade, signaling that the era of cheap pandemic-era financing has officially ended. Falling labor participation, vanishing savings, and rising bankruptcies are converging into a single, unmistakable pattern. It is the economic equivalent of a dashboard, where the check engine, oil pressure, and brake lights all illuminate simultaneously. While any individual indicator might be a false alarm, this specific synchronization of failures has preceded every major recession in modern history. Navigating this requires looking past the surface. When the media highlights job growth, look at the rise in part-time work. When they celebrate consumer spending, look at the credit data. When the NBER eventually declares this recession official, the news will simply be a formal recognition of the conditions people have already navigated for months. The official data doesn't create the reality, it eventually catches up to it.
So, if the everyday economy is buckling under debt, and the leading indicators have been flashing red for 6 consecutive months, why does Wall Street keep breaking records? The answer isn't human optimism, and it has nothing to do with economic recovery. We are looking for answers in the wrong place. The reality is, the old financial system has been quietly replaced.
In April, as conflict escalated in the Middle East and global supply chains braced for impact, the Dow Jones climbed more than 1,300 points, marking its best day in nearly a year. Zoom out to the global level, and the data paints a similarly confusing picture. The United States economy appears dominant, yet the dollar's share of global reserves has dropped below 58%, the lowest point since 1992. We keep trying to read these events using human logic. We assume fear, patriotism, or geopolitical strategy drives the tape, but those metrics are increasingly disconnected from the results. The financial system has begun operating through a different set of rules, shifting its foundational infrastructure to a network of automated mechanical plumbing. Trying to understand the modern economy by watching cable news is like staring at a broken dashboard. The real engines driving the world are now fully automated, operating completely out of public view. 20 years ago, the stock market relied on human portfolio managers. They analyzed earnings reports and modeled cash flows to determine what a company was actually worth in the real world. Today, 63% of all U.S. stock funds are held by passive indexers. That is more than $13 trillion of blind money receiving allocations on default, running entirely on autopilot. When you see a massive market surge during a crisis, you aren't seeing human optimism, you're watching a mechanical chain reaction. It starts when over-leveraged traders receive margin calls and are forced to immediately buy back shares to cover their short positions. That forced buying pushes the price up until it triggers the next phase. Commodity trading advisors are systematic trading firms running strict algorithmic models. Once the rising price crosses their hard threshold, their code mechanically flips their massive short positions to go long, automatically dumping billions of dollars into the market. This rapid buying kicks off a third reaction in the options market. Same-day option trading forces the dealers on the other side of those trades to stay delta neutral. To balance their books, they are mechanically forced to hedge by buying the underlying stock in real time, pushing the price even higher. Even the active hedge funds left in the space operate on massive leverage with strict drawdown limits. If a threshold is crossed, they don't hold a meeting to debate world peace. Their risk models force immediate liquidation. The narrative of a relief rally or a celebration of peace is a myth. What you are actually watching is a giant feedback loop of algorithms reacting to each other, blind to real-world geopolitics. This quiet replacement of infrastructure is also happening in global trade. For decades, foreign central banks used the US dollar. They used it because the American financial system was the only liquid plumbing available. If two peripheral countries wanted to trade, the transaction had to route through a correspondent bank in New York. This setup gave the United States a monopoly, allowing Washington to see the data of global trade and act as the supreme regulator. In 2022, the United States used that regulatory power to freeze roughly $300 billion in Russian sovereign assets and sever the country from the SWIFT banking network. That single action proved to every central bank on Earth that their entire financial lifeline could be immediately switched off at any moment if they went against Washington. The geopolitical reaction was immediate. The BRICS coalition rapidly expanded to include over a quarter of the global economy, coordinating a direct effort to build an alternative to American financial control. They deployed mBridge, a blockchain-based cross-border payment platform. These are the physical pipes that allow lumber countries to execute direct trade without ever touching a correspondent bank in New York. To pair with it, they launched the Unit. This is a blockchain-based settlement tool designed to give member nations a neutral measuring stick for pricing physical commodities, bypassing the dollar's monopoly on price discovery. By pouring concrete on this parallel mechanical system, these nations are engineering a permanent exit route from U.S. financial oversight. Algorithmic trading loops and foreign blockchains do not mean the American stock market or the U.S. dollar are going to collapse overnight. The actual immediate threat these structural changes represent is optionality. You can see this shift happening in the physical markets right now. Since 2022, central banks have been buying gold at the fastest pace in modern history. For 80 years, human investors and sovereign nations stayed inside the US-led system because it operated as an absolute monopoly. The exit doors simply didn't exist. Today, true power resides in the invisible, automated systems quietly running beneath the surface, far removed from the day-to-day political headlines.